Global financial markets turned sharply lower today as investor sentiment fell into extreme fear, driven by U.S. labor data, Japan's massive stimulus package, and a steep sell-off in technology stocks. Japan announced a 42.8 trillion yen stimulus package, roughly $280 billion aimed at supporting consumption and fighting inflation, but markets reacted negatively. The Nikkei dropped 2.3%, the yen weakened, and bond markets became unstable. Analysts are calling this a potential Minsky moment, signaling rising long-term debt risks. In the United States, the latest labor data shocked markets. Non-farm payrolls increased strongly, while unemployment ticked up to 4.4%. This triggered a broad sell-off. The Nasdaq fell 2.15%, the Dow Jones dropped 0.84%, and Asian markets followed, with South Korea's Kospi down 3%. The Fear and Greed Index plunged to 14, extreme fear, highlighting deep recession concerns. The tech sector, especially AI and semiconductors, faced heavy pressure. Nvidia dropped 3.15%, with AMD and Micron falling even more. SoftBank in Japan and Chinese markets also turned red. Bitcoin slid 6% to $86,250, signaling capital outflows from risk assets. On monetary policy, the Federal Reserve remains cautious as inflation stays stuck around 3%. Current market expectations are hold rates in December, 67 to 70%. Cut rates, only 30 to 33%. Rate hike, nearly 0%. This uncertainty is adding more weight to an already fragile market mood. However, the outlook for next year remains more optimistic. Even though sentiment is extremely negative right now, the Fed is nearing the end of its tightening cycle, and the long-term direction still points toward lower interest rates. Once the economy begins to absorb the rate cuts already implemented, markets are likely to recover, potentially from Q1 to Q2 next year. Tech stocks, crypto, and other risk assets are expected to lead the next growth phase. This is a difficult period, but it is also laying the foundation for a potential recovery in the year ahead. Thank you for tuning in. Don't forget to follow for more news.